Joining us now at the Mines and Money Conference is David Arkell. He's the CEO of the largest royalty company by market cap, Franco-Nevada. David, always good to have you on the program.
Thank you, Daniela. Welcome to Toronto.
Thank you. I love being here. And some news just came out on Franco-Nevada this morning. Analysts at Raymond James actually upping your forecast for Q3. So how are you positioned to, as we kind of are at the tail end of this year, to start 2017?
Well, in terms of just wrapping up on 2016, we got great growth this year. We're going to have 20 to 30% growth in our revenues and geos, just because we did so many acquisitions in the last 18 months. We did, deployed $2.1 billion buying Antapaccay, Antamina, Candelaria. So we're just seeing a lot of that growth as we get the full impact of that in our numbers this year.
Well, on the topic of mergers and acquisitions, a study actually came out from KPMG that found that actually North American merger and acquisition activity might not bring as much value as companies think to the acquirer. And in 39% of cases, they actually reduce the value for the acquirer. What do you think of that?
No, I agree. And so what I just talked about wasn't M&A. It was actually buying interests in mines and properties. Okay. And I think the trouble with M&A is generally the companies only sell when they're fully valued. You then have to pay a premium to take them out, and then you have a lot of costs in terms of management terminations and paying various settlement fees or paying debt payouts. So I always prefer to buy assets at a discount rather than buy a company at a premium, because you have to, there's so many stakeholders, you have to pay a real premium to be able to acquire those. And just sort of to finish off, how we're positioned going to 2017, we've just done all these deals, we've got the growth locked in, and so if we do nothing, we've got growth for the next 5 years, and then we have actually pretty steady production profiles for a very long time. Our average duration of our assets is over 30 years now, so we are already the #1 dividend payer in the world gold industry. We can pay our dividend for the next 30 plus years, even if we do nothing or buy not another thing. So we're very relaxed right now. We can wait for the bargains to come up again. We don't have to do anything right now.
Okay, and is that what you plan to do in 2017, is take a little bit more of a relaxed approach and not be as...
We have to be reflective of the marketplace.
Okay.
I think when we were talking before, we were really in acquisition mode. Okay. We hope to do even more deals with some of the super majors. The reality now is the market's turned completely. The equity market's open. The super majors now can raise debt at under 2% cost of capital. So why are they going to start writing deals with us that are going to cost them 7 or 8%? So I think the reality right now is on the gold window, in terms of us getting good deals, we can't really compete with the brokers in terms of issuing bought deals. So it's probably time for us now to start looking at other commodities. We're 95% precious metals in terms of our revenues and EBITDA. So there's better bargains, we think, in other commodities.
Oh, that's interesting. So like, which ones would you be
oil
eyeing?
And gas we've always been big at.
Okay.
We've had as much as 20% oil and gas 4 years ago in our revenues. We're down to less than 4% of our revenues coming from that sector. We have a separate oil and gas team. We've been bidding different oil and gas transactions. We're very well diversified in Western Canada. I could see us doing more deals.
So
there.
this will be your focus then?
Well, I think we just go where the best investment opportunities are, and as I say, we can't compete with bought deals in the equity market when that's active. So
let's look at the mining industry. It's been a great year for mining companies. Some companies up over 100%, and look at spot gold close to above 30% since the start of the year, while many had discounted gold last year. Do you think this is the end of the bear market? Is this, or where are we in the spectrum here?
I can't forecast the near term. I look at it, gold is like an emerging market currency. You get all this money, hot money flowing in. A lot of the gold price has been driven by a lot of hedge funds buying gold on the GLD, which is, impact investment demand. And that could flow out just as quickly on the other side. So if you see treasury rates moving up, or if there's any other concerns of what's happening in Europe with Deutsche Bank or with Greece or Italian banks, the market could go very quickly the other way. And I think Don Cox this morning was giving a message just along those lines, is that it's very easy for us to have a financial market accident. And when that happens, actually, the initial reaction is for gold to go down. People forget this. In 08 or in 09, gold went down with the rest of the market because it was a source of cash. But the big beauty of it, gold was the first thing to come back in terms of coming out of that downturn. So you're the best place to be in gold at the bottom of that market. I think it could play out very similarly as well. We're positioned that if there's another accident, we'll be able to pick up bargains. And we think gold is going to be the first place that's going to be improving going forward.
And going to the miners now, I know you've been critical of the mining space in the past, or not afraid to be.
I love the mining space.
Yes, I know, but you definitely have an opinion on it. So how do you see this mining space right now? Do you think that companies have been taking better positions, better steps in the right direction?
You know, everyone has been taught a big lesson in terms of managing their capital structure and being disciplined. And so I think that memory is going to be with the companies for a couple of years right now. They're going to be very careful going forward, make sure they don't get too levered up. But it gets forgotten as you go through the cycles, because all these boards now and all these management teams, they're very responsive to what investors want. And when you get in that bull cycle and the investors are saying, we're offering you all this money, we need you to build more projects and deploy more capital, and the industry will do it. And one of the key drivers for them is that their existing mines, when you look at what's actually developed, you don't count the undeveloped projects, they have a reserve life of maybe 9 or 10 years. And so the companies, each year they're ticking is saying, how do we preserve the optionality of our companies longer term? So they know at some point they actually have to buy or build something. And that's where the pressure will keep mounting. If the money's offered to them, they'll have to do it just as a matter of self-preservation.
David Arpeel, CEO of Franco-Nevada, thank you so much for joining us today.
It's a pleasure.
And thank you for watching our coverage from the Mines and Money Conference here in Toronto. We'll have more for you, so be sure to stay tuned to Kitco.com. Thank you so much, David. It was always a pleasure.